Yes, good morning. Thank you so much for having me. So yeah, we had a very large interest rate hike, 75 basis points, and pricing had been changing quite a bit coming into this meeting. So I just say two things, off the top. In a way, yes, I think there's a little bit of a feeling of relief on this, but we're coming from a period of significant volatility, both in terms of market performance, but also macro volatility. We've had big shocks on inflation and growth. So the key point is this is a very difficult situation. Markets are trying to calibrate and figure out the reaction function and sort of the path ahead. We still think there's more tightening to go. So we think there will be another 75 basis points in the next meeting, then 50, then 25, and 25 again. We think that'll engineer a so-called soft landing, bringing down inflation, which is a crucial point, as Chair Powell was making, but not necessarily inducing a recession. So it's a very narrow path, a narrowing path at that, but one where we still think the modal case is for a soft landing.
A lot depends on the data we see, isn't it, Aziza? Because we did get that retail sales slumping. We're also getting a GDP print at the end of July. If we get a negative number, could that send the markets on another spiral downwards?
Yeah, it's always difficult to say. And again, I wouldn't look so much just at the pricing of yesterday and today. I mean, these are coming off of, again, pretty extreme moves. On the one hand, we would say with the S&P down 20%, typically you're pricing a recession. But again, I think in terms more of valuation and the types of equity risk premiums we're talking about, that still doesn't really look attractive from our perspective on a short-term basis. So we do remain fairly cautious. We think equity markets, risk assets can feel a little bit more pain, tactically. So I don't think it's quite yet the time to dip in.
Okay, all this really having an impact on the dollar because it was soaring and then it fell back down again. I mean, traditionally, historically, when you look at the direction of the dollar, it's always been linked to the performance of emerging market assets. Now that we're seeing dollar index pulling off a little bit, how much of a relief does that give EM markets?
Well, this is one of those questions that we can discuss, time and time again. And I think it's certainly true that the U.S. dollar and EM have sort of an inverse relationship. But I would just say, us in emerging markets, we tend to often look at the dollar as a driver of our markets. But I would say pretty weak EM growth recently, but also over the past decade, has probably contributed to dollar strength. So yes, I would agree. There's some relief perhaps in the dollar peaking. We can debate that. But at the same time, some of the better data out of China, for example, might be a little bit helpful in helping EM and even bringing down the dollar. So again, I think it's too early to really get bared up on the dollar here. As I mentioned, probably a little bit more pain on risk assets over the course of the summer. But yes, dollar is very expensive, and on a medium to longer term basis, we do think the dollar will come down.